We'll start off this week with NVIDIA. Wicked price action last week. When the results first came out, it was up a few dollars, and then it was immediately down, like within 2 minutes, down $45. And then just started to climb, and well, you saw the outcome. Peaked over 2 trillion in market cap for a bit, ended just under 2 trillion, 1.9 something trillion. We'll see that number a little later on. If we look at its segments, it's driven by data center. So the question is, with this kind of growth, how long can this growth continue? Is this a repeat of the 1990s when the internet was being built out and the hardware suppliers for the internet just lit on fire? But at some point, I can even remember the conversation back then, at some point it's going to be built. What's going to happen then? The big demand would be over. Then it would be demand based on incremental innovation. Who could continue to keep the lead in the hardware to build out the internet? I think we have the same thing here. At some point, the building out will be done, but that could be 2-3 years. If we're going to value this, I think the appropriate model to value this is a 2-stage model, probably with a 3-year first term, a 3-year explicit cash flow with a high growth rate, settling into a typical growth rate for semiconductors after that period of time. Let's just look at its divisions. Look at OEM. We'll start at the bottom, work our way up. OEM, if you go back to Q2 of 2023, 140, Q1 of 23, 158, and it really dropped down. It's only at 90. It hasn't really recovered very much. Looking at Q4 2023 versus Q4 2024, 84 to 90, and it's a small segment. They could probably eliminate that and no one would care. Look at auto. Auto's been flat to declining. Going back to Q4 of 2023, 294, 296, 253, 261, 281. Nothing exciting going on there. Professional visualization, 463 up from 416, up from 379, up from 295, up from 226. That's looking good, right? Up from 200. It's a nice recovery. Q1 fiscal year 23, they were 622, dropped to 496, bottomed out at 2, and they're beginning the recovery at 463. They have not recovered the highs in that category yet, but for the last, what have we got, 1, 2, 3, 4, 5, 6 quarters, it's last 5 quarters, it's been going in the right direction. Gaming, kind of flat quarter over quarter. You go back to Q4 23, 1.8 billion, now 2.8 billion. That's fairly decent growth, but in Q1 of fiscal 23, they were 3.6 billion. They haven't recovered the highs on that one yet. And we look at data center. Let's go all the way back to Q1 of 23, 37.50, 38, not a lot of growth. 38.33, not a lot. 36.16, 42.84, and here's where it took off. When you got into Q2 of 24, that's where the story began, right there. And then it just exploded from there. 4 to 10, 10 to 14, 14 to 18, quarter over quarter. What are we looking at here? 24% growth quarter over quarter. How long can you keep that up before competition comes in? Now, I don't see much coming in behind them yet, but it is the story of all technology that it is going to get competition. And since this technology is building out, well, the infrastructure for the AI layer to everything, at some point it will be built. And then I think it'll be just a repeat of what we saw for the internet hardware companies, where after the initial excitement and the surge, at some point you had all this capacity, and all the sites started disappearing, all the .com started disappearing. I think you'll have the same thing here, that over time you'll have all of these models show up, all of these companies show up, and most of them will go away, and there'll be a couple that really dominate. Those that can get access to data will really dominate. But it's not as if every company is going to have an AI model in their backyard. A lot of it will be licensed. A lot of it they may not have the data for. So there'll be the overcapacity, of which NVIDIA will probably ride it. The question is, after this is over, it's not so much like hardware. This is a little bit different than the hardware, routers and switches, a little bit different. Think of ASML in lithography. They have a near monopoly. That does not mean they don't have competition. It just means that before their competition can come out with a better machine, they already have. They're the leader. Can NVIDIA keep doing that? If they can probably maintain a near monopoly on this for quite some time. But I do think it's a multi-stage model, not just looking at the growth rate and saying, okay, here we go. This growth rate, I think, is for a period of time. I had said that I think the short straddle pays. When NVIDIA was around 720, the short straddle was 100. Questionable whether that would have paid, considering NVIDIA is sitting at 788, $68 higher. It's a question whether or not the calls probably would have hurt you, even though the puts would have made money. It's questionable whether that would have paid. The short straddle just before earnings, 680 was the strike, 84 was the premium, 764 would have been the break even, 788, not good. I think did not work out, but at the same time I said, I'm not doing this trade. I just think it pays, but I am not doing this trade. So it was more of a pride thing. It's like, damn it, didn't work out. Okay, let's head in and look at rates. This week, we're going to, because we're getting GDP this week, second look, we also get GNI, which is gross national income. I'll explain the difference between GDP and GNI and why GNI would be spreading away from GDP at this point. Both money market rates and capital market rates rather well behaved all week. Money market rates are going to stay pretty anchored to where the Fed is until we get more visibility on what they want to do. Capital market rates, week over week, doesn't look like a lot, but it masks the volatility that happened during the week. Friday was a nice big day for TLT, and because of Friday, we eked out a gain on the week. All curves continued their inversion. Again, we are 585 days on the capital market curve, 472 on the money market to capital market curve. Canada even deeper. And I don't know which bank put this out. I saw a headline. I didn't read it, but I saw a headline that by the end of 2025, the Bank of Canada will have cut rates in half. 5% now. They're forecasting by the end of 2025 it'll be 2.5. I think Bank of Canada has 100 basis points of cuts this year. I don't know that they can wait for inflation to get to their target before they really do have to move because of the interest rate sensitivity of the Canadian economy and the level of household debt. If you want to have a good time, Google household debt Canada versus US. In 2008, the US had way more household debt than Canada. It is the other way around right now. Canadian household debt is way above what US household debt was in 2008 and way above where the US is right now. I don't think, and when you have that much household debt, that is far more interest rate sensitive, you're either going to completely crash the economy or you're going to have to lower rates and put up with an inflation rate that's above your target for a period of time. I don't think the Bank of Canada has a choice. I think you're going to see 100 basis points there, and I think at a minimum you'll see 75 basis points on the Fed. I do think it'll be probably more than 75, but the Fed thinks they're at 75 right now. Look at the balance sheet here. Down 52 billion, net down 18 billion because you had 33, almost 34 billion run out of the SOMA. Look at that. Cue the fanfare. We got a 6 handle on that balance sheet. When they started the runoff, we were 8.5, and now down to 6.9, 1.5 trillion in extra cash in the economy pulled out of the economy at the same time that rates are tightening, at the same time that unemployment is near record lows and GDP just keeps ripping, and housing prices are at all-time highs, and stock markets are hitting all-time highs. An economics textbook would tell you that that's a low probability outcome, yet here we are. So I think we're going to need new economic theories to account for this. I keep going back to the financial sophistication of the American market, in that you can use so many derivatives and so many contracts now to immunize yourself from interest rates that you can become basically insensitive to changes in rates. As long as you're not taking on any incremental new debt, you basically remain insensitive. Now, if that's the case, if you have that much financial sophistication such that you are rather insensitive, other than just the sheer cost of doing business, what do you need lower rates for? Given the situation, I think, among all the G7, the massive amounts of debt they have, the shift to the left we've had over the past 5, 6, 7 years, and just the sheer amount of social spending that has been done, that all has to be paid for. If you are in Canada, you will have seen the headlines come out this week that right on the backs of dental care, you now have pharmacare. So dental care is expected to cost some $13 billion, another $50 billion. Trudeau has given another $50 billion. Canada didn't. Trudeau gave it. It's Trudeau's name because it's all about his brand. He gave another $50 billion in commitments to Ukraine, which you guys are going to have to pay for. Remember, I left, right? I took all my money, all my capital, and I left. So these are not my bills. And now you have pharmacare. You're going to have to pay for that. So if you are unsuccessful in Canada, you're going to get stuff. If you are successful in Canada, you're going to have to pay for all that stuff. Well, that's going to add to debt. So the only real reason you'd need lower interest rates is the government simply can't afford it. And I think that's where Japan is. The idea that Japan will lift off the zero line at some point, I think is going to be a difficult thing to do, simply because of the sheer amount of debt to GDP that Japan has. What is it, 288%, getting close to 300%. US is over 100%. If you control for what the Fed holds, it's probably at 100%, but deficits as far as the eye can see. In Canada, the debt to GDP is lower than 100%, but deficits as far as the eye can see, and with the Liberal Socialist coalition, you're piling on more debt because all of this has to be paid for. It all has to be paid for by someone. So I think that just that alone, you can't have all the debt roll over at 5%. And I think the duration of the Treasury debt is somewhere around 6 or 7, because of the way they structure the where they issue money market, capital market, etc. I think it's around 6, which would mean that about every 6.5, 7 years, the debt completely rolls over. We've been in a rate hiking cycle for 2 years. We're going into the third year, and we're holding rates here. How long can you continue to hold rates here with more and more, a greater and greater proportion of your debt rolling over at higher rates? If the economy truly is interest rate insensitive because of the sophistication of financial markets, the neutral rate would have to be much higher. Will the Fed be true to the neutral rate, or will it look at the sheer amount of debt and the cost of debt and say, listen, it doesn't matter where the neutral rate is. We simply can't keep going on like this. The government needs lower interest rates. Otherwise things are going to get very bad very quickly. I'm not sure if that's a conversation they're having. I think Powell would say, no, we are apolitical and we don't make decisions based on that, but how can you ignore it? Money market fund assets decreased 5.33 billion coming out there. Retail did increase, though, 3.64, but in prime, reaching for some credit risk to get better yield over government rates. Same with, sorry, not institution. Institutions down 9. I was going to say same there, but not. They are both down in both government and in prime. Okay, March 20th, FOMC. Now 24 days away. I can get a better color there. 24 days away for that meeting. 96% probability of 0. Call that 100. I don't think anybody's expecting anything in March. That's up from 90%. Fourth quarter GDP, that is our second look at fourth quarter GDP. We also get GNI, we get that in 3 days. Canada GDP for Q4, we get it monthly. We've seen the 3 months. I think we're not going to be surprised by that, but we have the preliminary for January. Get that in 4 days. That's our first look at January. US PCE in 4 days. This is for January. The forecast year over year for core is 2.8. For the headline, the full number, 2.4%. You come in at 2.4, Fed target of 2%. I don't know why you would think that there is more work to do, especially on a 3-month and 6-month annualized basis. You're at or below the 2%. If you get to that number, I'm not sure what the holdout is. Monday you have a 5-year note auction, Tuesday 7-year note, and a lot of Fed speak. Tuesday you have Barr, Wednesday Bostic, Collins, Williams. Thursday Bostic, Goolsbee, Mester, Williams. Goolsbee seems to be the one that is more beneficial for markets. Friday Waller, Bostic, Daly, Kugler. Waller seems to be the one that is more negative for markets. Waller is, what's the rush, guys? Let's hang out here for a while. Whereas Goolsbee, the last time he spoke, was, why would we hang out here this long when we can clearly see that it's coming down? What would be the point? Since it works with a lag, so does it work with a lag with cuts? Why, if we know we're cutting, let's cut. So Thursday, maybe Goolsbee can lift the market, and Friday, Waller can bring it right back down again. So buy the market Wednesday night, sell on the Goolsbee speech, and then buy after the Waller speech. Maybe that's a good trade. Effective federal funds rate 5.33, 75 basis point lag if you buy into the lag. Reverse repo, 520 billion down from 532, down 12 billion. February 15th still remains the low on the reverse repo. Bank term funding program, 164 billion, down 541 million. The TGA really came down 43 billion, down to 788, and reserves down 14 billion to 3.52. So take the 12 and the 14, there's 26 billion. If we're thinking about where the optimal level of reserves are, or the necessary level of reserves are to remain in an ample reserves regime, it is the combination of whatever is in our reverse repo and whatever is in reserves. Oh, almost forgot, June 12th. Big change here. Last week, the probability of 2 or more cuts was 27.9. That has now dropped to 14.8. And by June, the probability of no cuts is now 33% versus 18%. Pretty much unchanged, the 5.25. So the probabilities moved up this way, but only 15% probability now based on pricing, of 2 rate cuts or more. Real rates have all pulled back, and break-even rates almost unchanged, couple of basis points move. Big story here is on Fed funds futures, now pricing in 71.5 basis points cuts. The Fed is at 75. The market is now more pessimistic than the Fed, not more optimistic, but more pessimistic. At this point, I would feel very comfortable going long the December Fed fund futures. The December futures are at implying a rate of 4.615, which is from the effective federal funds rate now 5.33, with slightly less than 3 rate cuts. I think they have more than 3 rate cuts in them. So I would probably be long the Fed funds futures for December at this point. You can see how the implied rates have changed. This is April 5.3, now up to 5.32, getting closer to the 5.33 where the effective rate is now. Going out to the end of the second quarter, the implied rate is 5.115, implying 15.5 basis points cut, so almost an even odds of one cut by the end of the second quarter. End of the third quarter, 4.795 is now 4.915. So in the third quarter, that implies 26 basis points, which is basically one rate cut. And then you have another 30 basis point drop in Q4, implying one rate cut there as well. So spread out over Q2 to Q4 from here to the end of the year, the market is less pessimistic than the Fed. I think that's wrong. I think pricing in almost 6 1/3 rate cuts was wrong, but pricing in less than 3 I think is wrong. I think if the market was pricing in 4 to 4.5, let's say, if it were 100 basis points to 112 priced in into the December contract, I'd say I'd be indifferent on a trade. I would look at that and say I think that's fair, but at 71.5, I think being long makes a lot of sense. Let's look at TLT up 1.2%, SPY up 1.66%, and we could say that is pretty much all NVIDIA. Implied volatility just disappearing. 13-week implied volatility still 0%, the lowest in the last quarter. For the last half year, 3%, and on the 52-week went from 10 down to 7%, just dropping off. Given that we are 71.5 basis points on the Fed Fund futures below the Fed expectations, I feel very comfortable on TLT with the 93 puts, 30 to 45 days to expiration. The March 15th puts have 86 cents of premium. The April 5th puts, which lands in the middle of the 30 to 45, has $1.35 worth of premium. I think the March 15th is too close. But it does avoid the Fed. The Fed is March 20th. So it does avoid the Fed, 86 cents at the 93. It looks like it's been fairly successful in holding the 93. Sure, it dips down below it, but it seems to get bid up nicely over the 93. I think based on the last minutes, the Fed saying we're at the peak. We think there's 3. We just need a few more months of data, and we'll begin to start cutting rates. Bostic is saying sometime in the third quarter. So if all of this is in place, I think the downside for TLT is limited. That doesn't mean there'll be no volatility. I just think that 93 is a nice place, and I think 93 holds. And if it is put to me, I don't mind it being put to me at 93. If I didn't want them, I would just turn around the next month and do covered calls at 93 and get that premium as well. But if they're put to me at 93 at $1.35, I'm 91.65. I don't see 91.65. Now, if Fed Fund futures were sitting at 150 versus 75 for the Fed, I would say I'd be a little concerned about some downside risk to TLT. But being that we're sitting here and here as far as what the market is pricing in for rate cuts, that's going to be reflected in yields. The probabilities would at least infect your sentiment of where yields are and would affect yields. I think 93 holds. Time will tell, right? Okay, mortgage rates 6.9, big jump up this week, 13 basis points. But this is just till Thursday. We don't have the benefit of Friday. Friday was a big down day for yields. Yields dropped, so chances are mortgage rates probably pull back as well. Looking at the Thursday over Thursday, 10-year up 9, the FRM fixed rate mortgage up 13, so the spread increased by 4 to 257, still well below the 3.0. I think it was 308 or 309, which was the record for this cycle. I took all the mortgage REITs and housing stock week over week percentage changes out because I just don't think there's much excitement in housing stocks right now, not until you actually start getting cuts. The housing stocks had a tremendous run over the last year and a half. I think they consolidate here for a few quarters, go sideways. And then when rate cuts start, I think they'll do a little bit better. Plus, I think that sometime in the first half, a small correction, even a 5, 6, 7% correction, maybe not a full 10%, but 5, 6, 7% correction on the index would be a healthy thing if we want another leg up. But if we just continue up, the multiple is expanding. We're over 21 now. And at the very end, I will adjust the multiple for the surprise factor, for the Q4 earnings surprise factor. I'll adjust it, and we'll still see that even adjusting for the surprise factor, we're still quite high. So if you're wondering where all the week over weeks are, last week I said I don't think there's much excitement to see here at this point. It's time to put them in the back seat, not throw them out of the car. Housing stocks I think are going to be a multi-year winner. But with a respectful correction at this point in time, and then buying in at a lower price, maybe in a quarter or 2 quarters, sometime in the summer, and then when you start to see the rate cuts, I think they'll respond better when this starts dropping. And I think once you get below 6.25 and below 6, that will really help. Mortgage apps, this is not a pretty number, down 10.6%. For the week ending February 16th, down 10.6. That's big. Existing home sales for January up 3.1%. We get some housing data next week. New home sales Monday, that is for January. And the housing stocks will always respond to this. So if it is not good, down it goes. If it's good, up they go. But I don't know that other than a data point reaction, that it sets up the next leg higher. Or even a leg lower. I think it's just the volatility for the day, which means buying the housing stocks ahead of this report is actually betting on this report. Housing price index and Case-Shiller we get for December. October was a record. November pulled back ever so slightly on Case-Shiller, but still sitting almost near a record. Now we get the December read. Do we beat October? Does 2023 end with record high housing prices? We'll find out. Thursday, pending home sales, and that is for January. IG still continues to say nothing to see here. Look at that, just pulling back. I think that is a new low on the cycle, 93 on investment grade. Issuance for January. Even at these levels, their issuance is just not slowing down. 234 billion. This is data from SIFMA. That is free. You can go to sifma.org, and they have a whole bunch of data on issuance. That is up 27% year over year versus last January to January 23 to January 24, when yields were lower, when rates were lower a year ago. We're 27% on the issuance. High investment grade up 191 billion, high yield, I shouldn't say up, issued 191 billion, high yield issued 31.4 billion, and just a tiny little bit of convertible debt in here, small cap typically. But look at that issuance. That is surprising. And look at those spreads. Nothing to see here. Okay, let's talk about gross national income for a little bit here. I don't know that we're going to get a deep understanding of the difference between GDP and GNI in terms of what is actually causing the difference in the growth rates. But for the US, I have GNI and GDP up on the screen. GNI is above GDP. For a country like China, GNI tends to be below GDP. So how we get there is we have gross national income. We start with GDP. Then we add factor incomes in and subtract factor incomes out. So what are factor incomes in? These are residents in other countries. When we say residents, we're saying U.S. residents that just happen to be in other countries. Or when we're looking at factor incomes out, these are non-residents in the U.S. They're not a resident of the U.S. Sending money out. A good example would be, let's say that Japan, for example, owns a lot of U.S. bonds. So when the Treasury pays interest, that is money out. That is heading to Japan. that would make GNI lower than GDP. Factor income in is somebody working in another country but is a resident of the U.S. That money would be coming in. Let's say a resident of the U.S. owning an asset producing or an income producing asset in another country, that money would be coming in. So a simple way of conceiving it is GNI is equal to GDP plus money in minus money out, and that includes foreign aid. Somebody had asked me how foreign aid is dealt with. It lowers GNI. So if country A simply just sends money to country B, it does not contribute to GDP. So there's no added benefit to GDP here, and it does lower GNI, but it raises the GNI in country B. If, on the other hand, country A buys bullets that are made, let's say country A is the U.S. buys bullets that are made in its own country in the U.S., that does add to GDP. And to the extent that the cost of producing these bullets is incurred in the U.S., it does add to GNI. And then these bullets are sent over to country B. Then you do have foreign aid, but that does add to GDP as opposed to just giving cash. So imagine that we have, and I'll just clear off some of the screen here so I can give you a small example of how this works. Let's take an economy that has one company with no taxes, and this company produces, let's say, $1 million in revenues. And let's say all the expenses come to 50%, $500,000. That means there's $500,000 in taxes, and let's say that this company is 100% owned by its own domestic citizens. What is GDP? GDP is the sum of all output. GDP is $1 million. What is income? Well, all the expenses is somebody else's income, plus the income is the income to all of the owners of this business, would equal GNI. GDP would equal GNI. So if you take a closed economy, which really has no trade with the rest of the world, its GDP should equal its GNI. As an economy opens up, then you have deviations from GDP to GNI. So let's say this economy opened up to foreign direct investment, and right away 50% of this company was sold, shares were sold to foreign ownership. What is GDP? What is GNI? GDP would not change. GDP would still be produced within the borders of that country. 500,000 in expenses would be somebody's income, that would be GNI. Domestically, 50% of the company is owned, so 250, this 500 would be added to the 500, GNI would be 750,000. And the other 250, if all the profits are paid out in dividends, goes to the other country, that boosts the GNI of the other country. So if you have more foreigners owning assets in a particular country, the difference between GDP and GNI would increase. So depending on whether GNI is above or below GDP, we can tell what at least to some degree, where the ownership of the assets are. With GNI below GDP, you probably have a lot of foreign companies that own assets in your country. With GDP or GNI above GDP, the residents of that particular country probably own assets in other countries that then bring money in. And in the U.S., we have that case where GNI is above GDP. So when we look at the growth rate of GNI and GDP, let's say you have GDP over the course of the year growing at 3.5% and you have GNI growing at 1.5%. How can we account for the lower growth over the course of the year? Would we say that GDP is broken or that GNI is broken? GNI, by the way, is the best measure of the growth of the spending power of an economy. Because over here, let's go back over here, GDP was $1 million. Is that a good measure of the spending power of that economy? Not when 250,000 leave the country. The GNI, the 750, is what is left. That is a measure of the spending power of an economy. So we look at the growth rate of GNI. That tells us how much income is available within the borders of that country for growth. GDP doesn't necessarily all belong to the citizens of the residents of that country. Well, I should say the legal residents, regardless of where they live. So if you have an economy that's growing at 3.5%, but that a greater proportion of the assets of this economy are owned by foreigners, or a smaller proportion of foreign assets are owned by domestic citizens, you would have a slower growth rate in GNI. And GNI is the better measure of the potential spending power in the economy, because that is the income that is received, not the measure of output that is produced. So we get our next look at GNI on the second read. So third quarter GDP, we know, I think they was at 3.2% it came in at. And then we will look at GNI. And if GNI came in at 1%, then we would say, well, over the fourth quarter, there had to be some shift in ownership of assets. Either there was more foreign-owned assets within the U.S., or there was fewer foreign-owned assets from the domestic residents in the U.S. In 2022, GNI was 25.8 trillion, GDP was 25.4 trillion. If you have GNI growing at a slower rate than GDP, let's say GDP is growing at this rate, GNI is above GDP, but it's growing at a slower rate, at some point they would cross. If that continues on, GDP would exceed GNI, which is more typical of emerging markets. Even China, being the number 2 economy, has GNI below GDP. So let's see what that number looks like on Tuesday. But the idea that we're measuring GDP, it's just another way to measure GDP, is not entirely true. The GNI is a better way to measure the spending power in an economy, so that if we were looking at potential increases in consumption, we would look at it based on the growth rate of GNI plus the change in credit, the growth rate in credit, as opposed to the change in GDP plus the growth rate in credit. Okay, let's look at SPY, another all-time high. Every week, right? 507.85, that is the closing price on Friday, hitting an all-time high. Intraday, the SPX, the index itself, broke 51. Closed at 5088.8, but it did break 51 before pulling back quite a bit. As far as a candle chart goes, if you see this last candle over here, it looks like this, right? You had the candle above it before it looking like this with these little wicks, and you had a really long wick. And that there's a name for that. I think it's called a hammer. I'm not really sure, but it's usually a bearish signal when you have something like this on a candle chart. But still, even with a bearish signal, it pulled out a bullish ending, 507.85. So I don't know how you're going to interpret how candlestick charters are going to interpret that. Is it called a hanging hammer, swinging hammer? I forget what it's called. Somebody who is more adept or more knowledgeable in candlestick charting could probably put a comment underneath the video explaining what that thing means. And if you are more expert in candlestick charting, tell me, does the candlestick outweigh the closing price? Or because the closing price is extremely bullish, another all-time high, and then you have a weekend to digest it. Which one wins out? Be curious to know. Let's look at 4-quarter operating earnings, 242.76 from LSEG, up from 242.57. Not much, but still, that is the right direction. However, SP Global says, nah, 240.40 was last week, 240.18. It's a mix. Take the average of the two, use the closing S&P. You are at 21 times earnings, peaking above the 21 now. 21 times forward earnings versus 20.72. If we look at Q4 23 and we look at the LSEG data and look at the surprise factor for earnings, 6.8. So if I adjust the average of these two and I multiply it by 1.068 to get to, well, what would earnings be if we include the surprise and then use the closing price? I get to 19.73 times forward earnings. You know, if it came in at like 17.5, you'd say, well, you know, I mean, if they can pull off the surprise, that's fine. But even if they can pull off an almost 7% surprise factor on earnings all year long, Q1, Q2, Q3, Q4, hit the surprise factor on that, they'd still be at 19.73 times the forward earnings. This is the troubling part. 1.1 surprise factor on revenues. That is for the fourth quarter. So to compare, to have a good number for that, we have to use the GDP deflator. The Q4 GDP deflator was 2.6. So just to have, if we think about revenues in real terms, negative 1.5% in real terms, because if GDP was 2.6 and the 500 only pulled out 1.1 on their revenue increase, the 500 would be as closely representative as GDP as possible, I would think. On a real basis, if we use the 2.6, 1.5, now it's not the 500 is not the economy, but the 500 are so large in terms of their revenue as to be very representative of the economy, because every sector is represented. And if we think of the 500 as the most profitable, because there is a profit requirement to be in the S&P 500. If we think of them the most successful, the largest, the most profitable, they should be leading the economy. The smaller companies would maybe be dragging them down, drag the number back down. They should be leading 1.1, up 1.1 on revenues. I find that a little bit troubling. Also, assuming the surprise factor of 6.8, getting to a multiple that's still pushing 20, a forward multiple still pushing 20, even giving the benefit of the doubt and saying, okay, you'll do it again, I still find rather troubling. But I cannot ignore the fact that we have momentum. Let's look down here, NVIDIA. The AI story continues. And I have lived through one of these stories before with the internet. Quarter after quarter, the hardware producers, oh sure, the websites weren't generating any revenue, much like the AI models that are being built right now are pure expenses. Many of them are probably not generating any revenue, or certainly not covering their costs. That was the .com part of it. But the backbone of the internet itself, the hardware needed, those companies were selling and making money. And as long as they kept producing earnings, that story, the .com revolution, continued and continued. NVIDIA is that story. So it continues. 788.17 is where it ended. 1.97 trillion market cap. It peaked over 2 trillion for just a little bit. S&P peaked over 5,100, or I should say SPX, the index. SPX peaked over 5,100 for a bit and then just pulled back at the end of the day, but still closing at all-time highs. Year to date, they are up 63.63%. And it was a big day. I had mentioned this before that it will either continue the AI story and the market will go on to new highs, or it will kill the AI story. And sure enough, they're continuing the AI story. So yeah, there are some things to be worried about: the revenue growth versus the GDP deflator, the aggressiveness of the surprise factor 6.8, assuming that we can do that every quarter in 2024, you're still pushing 20 on the multiple. Curve inversions this deep for this long, but on the other hand, we know all of that, and look at this. It just didn't matter, even knowing all of that. And after, a 34-year period, Japan's index has now hit new highs. Although you cannot compare the two, because you would have to look at, well, what was it in 1990? And just inflation alone, if there was no increase in the multiple, and earnings went flat but just increased at inflation, just inflation alone would have made that number a lot bigger. So they're not the same number. Having a number, let's say 30,000 today versus 30,000 34 years ago, those two things are not the same number. You'd have to look at well, take the whole market cap, and what is the purchasing power of all of that market cap today that pushes the index to this to a new level versus what it was in 1990. So it's not the same. On an absolute basis, you can say we have an all-time high in the Nikkei, but on a relative basis, in terms of how much is it worth for me today, it's certainly not worth what it was in 1990. It's too long of a period to be comparing them that way, but still, there you go. And I think Europe, some of the European indices are hitting all-time highs as well. With who have we got in recession now? UK in recession, Japan in a technical recession, Germany most likely in a recession, Canada probably knocking on the door of the recession, but the US, that is a different story altogether. Implied volatility. Some reason Interactive Brokers is just not giving me the numbers. It's just I had them Friday morning, and then it did a couple of clicks, made a little bit of noise, and then my grid disappeared, and I logged in again, and my grid is gone. Maybe it's saying, okay, because I have transferred my accounts now. So maybe it's saying, okay, you're not part of the Canadian family anymore. You don't get to see this data. I'm going to have to check on Monday, but I may have to open my Costa Rican account sooner than I thought, but I am not a resident yet. My application is in process from January 18th, and it takes a certain amount of time, but I stopped being a resident of Canada November 29th. Now my accounts have been transferred, so I had access until the accounts were transferred. Am I going to have a period of time where I'm blind? I certainly hope not. I'm going to have to find a way around that, but I do not have my implied volatilities for you. And that is it for this week.